Hi, my name's Guy Baker, and I'd like to ask you a simple question. Do you think all investment portfolios are the same? Intuitively, I'm sure you know that the answer is negative. But do you know why? See, I've learned a shocking thing talking with seasoned advisors and stockbrokers. They literally do not know how to build a portfolio using historic data and the scientific method. They have no measurable process for building investment portfolios. Now, what if I told you our portfolios over any 15-year period has almost a 95% probability of performing at or better the benchmark for the same portfolio? You might ask, how is that possible? Well, the research and data behind our portfolios was developed by 5 Nobel Prize winners dating back into the 50s. Their research shows the stock market is not homogeneous. In other words, there are submarkets within the total market that outperform the market as a whole. And since this is true, then doesn't it make sense to study these submarkets and understand how these submarkets perform inside a portfolio? See, our research shows there are over 360 identifiable strategies and theories on investment. So ask yourself, which one is the best one? And if you boil them all down to their core essence, there are basically 3 factors you need to take into account when looking at submarkets. See, our research shows that the size of a company, called capitalization, impacts stock performance. Secondly, the book market ratio has an impact on return as well. This is the ratio of net worth to capitalization. And finally, how profitable a company is determines value over time. Now I know these may seem obvious, but we analyzed hundreds of portfolios and found that rarely do portfolios ever take into account all 3 of these anomalies. You see, we call these factors anomalies because they are unique and unusual, and they have to be captured by creating asset classes to track the research. So how you combine these asset classes determines the outcome of your portfolio over time. At Wealth Teams, we've learned how to do this. We have recreated a proven methodology for determining how to build a portfolio using scientifically tested conclusions that researchers have made about all 3 factors. This proven methodology is called the efficient frontier. So how does it work? Well, research has shown that over any 15-year period going back to 1926, 82% of the time, small companies have outperformed large companies. And doing the same research with the book-to-market ratio, we've found that a high book value outperforms a low book value 97% of the time. And when it came to profitability, 100% of the time, over any given 15-year period, highly profitable companies outperform low profitability companies. Now, while this does not mean you ignore those lower performing companies, it does mean you want to favor the companies which outperform their peers. So this weighting is analyzed by a methodology we call the efficient frontier. Now, I know this may sound a bit complicated, but stick with me here. Let me show you how a simple example can demonstrate this. Let's look at just the U.S. market. There are 5 funds that we use in our diversified portfolios. We use these funds to capture the research I just described. And they cover the majority of publicly traded companies in the U.S. domestic market. There's also a similar list for international stocks and for fixed investments in emerging markets. But our goal here is just to look at the U.S. market and find the best combination, the one we expect to provide the highest return for the least amount of volatility. Now, if you want to diversify among these 5 funds, you could just put 20% in each fund, right? And have a widely diversified portfolio. After all, you would own 7,800 individual stocks, but this would pay no attention to the research. You could invest, however, more of your money in, say, larger companies than smaller companies. Now, a lot of funds do this. The S&P 500, for instance, is an example of this method. Alternatively, you could put an equal amount in every stock. So, which is the best way? Well, let's test it. We're going to put 100% of your investment capital in just one fund, the core fund, which covers the entire marketplace and doesn't weight towards anything. So we can see how that's done going back to 1970. And we can adjust this and put, say, 95% into that core fund and then maybe 5% into small company funds. So we could put 90%, for instance, in the core, 5% into small companies, and then the remaining 5% into large cap value. So we could keep doing this over and over, and there are 3,125 different combinations if we do it in 5% increments. That's how many combinations there are. But in all those combinations, there's only one, just one, that is optimum for the amount of risk that you're willing to take. So which one is it? Which one's the best? Do you know? Well, if you don't know, join the club. No one could possibly know unless they did the analysis. And that's what we do here at Wealth Teams. We analyze the performance of this data going back into the 20s, and we look at the performance of each of the asset classes and at the volatility, the standard deviation of risk for each portfolio based on each of those 3,125 allocations. And we develop a scatter graph like this one. You see, each individual dot represents one outcome from all the combinations that are available. And if you look closely at the scatter graph, you're going to notice there is a maximum limit along the top of the dots, and it looks like a curve, doesn't it? And this curve is called the efficient frontier because it's the optimum place on the scatter graph. It's the place where you get the optimum return, the best return for the least amount of risk for each of those 3,125 portfolios. Now look at this yellow dot in the middle. This is one possible outcome, and it represents maybe a portfolio that somebody gave us to do an analysis. But notice it's in the middle. It's not on the line. It's not on the efficient frontier. Now, there's nothing wrong with this portfolio. It has all the component parts, widely diversified, 7,800 stocks in that allocation. But it's just not the most efficient allocation for the designated amount of risk this investor has told us they're willing to take. So, what do? Well, you'd have to move the dot up to the top spot on the curve to have the most efficient portfolio. So we might say this yellow dot is buying too much risk right now for the return that is expected from this allocation. So, do you know how much risk you're buying in your portfolio? See, the yellow dot is buying too much risk in this scatter graph. And had it been placed on the efficient frontier, it would have grown by about 20% more over the same period of time than it did where it is. So, where would you rather be on this graph? Someplace below, down where the yellow dot is? Or would you rather be on the efficient frontier? Now, if this makes sense to you and you would like to know more about these factors, visit our website or contact us. See, we can do an expected return analysis and tell you how much risk you're buying and where you are on this efficient frontier. And if you would like to learn more about these factors, please feel free to contact us directly or visit our website so that you can be educated about how to select the optimal portfolio for your retirement needs. We would love to hear from you. Thank you.